Investing is not just about numbers and market trends. It's also deeply influenced by human emotions. Emotional investing refers to making investment decisions based on feelings rather than logic or analysis. This approach can lead to significant financial losses since emotions often cloud judgment. For instance, fear might lead an investor to sell a promising stock during a temporary dip, while greed could push them to invest in a trend without proper research. Experts warn that emotions like fear and greed can disrupt rational decision-making processes. These emotions can compel individuals to buy high and sell low, which is a counterproductive strategy in most investment scenarios. Understanding how emotions affect investing can help individuals steer clear of common pitfalls. Investors are often advised to detach their emotions from their investment activities. By acknowledging the role of emotions in investing, individuals can begin to develop strategies to mitigate their influence. The concept of emotional investing might seem abstract, but its consequences are very real. By focusing on long-term goals and maintaining a disciplined strategy, investors can avoid the traps of emotional decision-making. Fear and greed are the two main emotions that drive irrational investing behavior. Fear is a powerful emotion that can cause investors to sell their holdings during market downturns, often at significant losses. The fear of losing money can overshadow the potential for future gains, leading to panic selling. Greed, on the other hand, can lead investors to chase market trends without thorough analysis. When a particular stock or sector is performing well, the fear of missing out can drive investors to buy without considering the fundamentals. This behavior often results in poor timing, as they may purchase at the peak of a trend, only to face losses when the market corrects. Greed can blind investors to the risks associated with their decisions, leading to overexposure and potential financial harm. Recognizing these emotions is crucial for investors who wish to make rational decisions. It's important to remember that markets naturally fluctuate, and reacting impulsively to every change can lead to suboptimal outcomes. Developing an understanding of these psychological triggers can help investors maintain a balanced perspective. By doing so, investors can make more informed decisions that align with their long-term financial goals, rather than being swayed by temporary emotional impulses. One of the most common pitfalls of emotional investing is panic selling. When markets experience a downturn, fear often drives investors to liquidate their assets at a loss. This reaction is typically based on a short-term perspective, overlooking the possibility of market recovery. Panic selling can significantly harm an investor's portfolio, as it locks in losses and prevents participation in potential future gains. Another frequent mistake is chasing trends without proper research. The allure of high returns from trending stocks can be irresistible to some investors, leading them to make impulsive purchases. This behavior is often driven by the fear of missing out, but it can result in buying at inflated prices. When the trend reverses, these investors are left with significant losses, having failed to analyze the underlying value of their investments. Overreacting to news headlines is another trap that many investors fall into. The constant stream of financial news can create anxiety and prompt frequent trading. Avoiding these pitfalls requires a shift in mindset and a focus on long-term objectives rather than short-term market movements. To counteract the influence of emotions, investors must establish a rational investment strategy. The first step in this process is setting clear goals. Understanding what you want to achieve with your investments is crucial for maintaining focus and discipline. Whether it's saving for retirement or building wealth, having defined objectives will guide your investment decisions and help you stay on track during volatile periods. Defining your risk tolerance is another essential component of a rational strategy. Every investor has a different capacity for risk, depending on their financial situation and goals. Understanding how much risk you are willing to take helps in selecting the appropriate investments that align with your comfort level. Creating a diversified portfolio is also key to a sound investment strategy. Diversification involves spreading investments across various asset classes to reduce risk. By not putting all your eggs in one basket, you can mitigate the impact of any single investment's poor performance. By adhering to a well-thought-out strategy, investors can navigate market fluctuations with confidence and remain focused on their long-term goals. Section 5. Strategies for managing emotions. Managing emotions effectively is critical to successful investing. One of the most important strategies is sticking to your investment plan. By having a clear, predefined plan, investors can avoid making impulsive decisions based on temporary market conditions. Seeking advice from a financial advisor is another valuable strategy. An advisor can provide an objective perspective, helping investors to see the bigger picture and avoid being swayed by emotions. Advisors offer guidance based on experience and expertise, which can be particularly beneficial during turbulent times. Their insights can help investors stay calm and focused on their long-term objectives. Limiting how often you check your investments is also crucial. Constant monitoring can increase anxiety and prompt emotional reactions. By setting boundaries around when and how often you review your portfolio, you can reduce stress and maintain a clearer focus on your long-term strategy. This approach helps investors avoid the temptation to make frequent changes based on short-term market movements. Through these strategies, investors can maintain a more rational approach to their financial decisions. Section 6. The importance of long-term thinking. Long-term thinking is a cornerstone of successful investing. Focusing on your long-term goals rather than short-term market fluctuations can lead to better financial outcomes. Markets are inherently unpredictable in the short term, but over the long run, they tend to trend upward. Keeping this perspective helps investors remain calm during periods of volatility and avoid making rash decisions. Patience is vital in investing. It allows investors to ride out market downturns without panicking. By maintaining a long-term focus, you can capture the growth potential of your investments. This approach requires discipline and the ability to trust in your investment strategy, even when the market is turbulent. Discipline in sticking to a long-term plan is crucial. Over time, this approach leads to more stable and predictable investment outcomes. By staying committed to a long-term strategy, you can build wealth over time and achieve your financial objectives with greater certainty and peace of mind. Section 7. The role of patience and discipline. Patience and discipline are fundamental traits for successful investors. Patience allows you to wait for the right opportunities rather than rushing into investments based on short-term trends. It helps you to stay calm during market downturns, recognizing that these are temporary phases in a long-term journey. By being patient, you reduce the risk of making impulsive decisions that could harm your financial health. Discipline involves adhering to your investment strategy, even when emotions are pulling you in different directions. This trait ensures that your decisions are driven by logic and analysis rather than fear or greed. Together, patience and discipline create a powerful framework for investing. By cultivating these traits, investors can build a robust portfolio that withstands market volatility and leads to sustainable growth. By embracing these qualities, you can achieve a more balanced and successful investing experience. Section 8. Encouraging rational decision-making. Encouraging rational decision-making in investing is about fostering a mindset that prioritizes logic over emotion. One key aspect of this is education. The more informed you are about financial markets, the better equipped you are to make rational decisions. Understanding the principles of investing, such as diversification and risk management, can help you develop a solid strategy. Another important factor is self-awareness. Recognizing your emotional triggers allows you to take proactive steps to manage them. This might involve setting rules for yourself, such as not making any investment decisions during periods of high stress or uncertainty. By being aware of your emotions, you can prevent them from dictating your financial decisions. Seeking out diverse perspectives is also beneficial. Engaging with a community of investors or consulting with professionals can provide new insights and help you see beyond your biases. By fostering a rational mindset, you can improve your investment outcomes and achieve your financial goals. Section 9. Conclusion. Avoiding the pitfalls of emotional investing is essential for long-term financial success. Understanding the psychology behind investment decisions and recognizing the influence of emotions like fear and greed are critical first steps. By identifying common pitfalls such as panic selling, chasing trends, and overreacting to news, investors can take steps to avoid these traps. Developing a rational investment strategy and managing emotions effectively are key components of successful investing. Setting clear goals, defining risk tolerance, and creating a diversified portfolio provide a strong foundation for making informed decisions. Strategies such as sticking to a plan, seeking advice, and avoiding constant monitoring help manage emotions and maintain focus. Long-term thinking, patience, and discipline are vital traits for investors who wish to achieve their financial objectives. By maintaining a focus on long-term goals and cultivating these qualities, investors can navigate market volatility with confidence. In conclusion, by understanding and implementing these strategies, investors can make more rational financial decisions. Through patience, discipline, and a commitment to rational thinking, investors can build a more secure and prosperous financial future.